Welcome to Gold Silver Pros.
Hey everybody, this is your host, Robert Keens with Gold Silver Pros, and it is Tuesday, February 6, 2024. This is your weekly market wrap-up and quite a bit to talk about from an economic and story perspective. While the gold and silver are doing pretty much like we expect them to, I'm going to show you the paper derivative markets and how spot price is determined here at the end of the show. Stay tuned for that, but first let's get into the news and what's really going on. And as I take a gander over the economic calendar, one thing that sticks out to me last week there are a bunch of different things going on. Home prices are rising, and I think that's going to make housing prices less affordable. According to the S&P Case-Shiller Home Price Index, a measure across 20 cities in the U.S., prices were up 5.4% last month after being up 4.9% the month prior. So real estate prices keep rising, continuing to make them less affordable. Considering that rates are also rising. We'll get into rates rising here in a moment. At some point, that real estate market is going to break, and there are signs that it's already breaking, but I think it's past the point of no return in terms of us having a positive growing real estate market until we hit the next recession. Consumer confidence is up a bit. Employment numbers were pretty rosy according to the government, not as rosy according to the private report from ADP. And there continues to be a divergence between ADP and the government report. ADP had an increase of 107,000 jobs compared to their measure last month of 158,000. And economists expected ADP to print 150,000. So the job picture not looking so rosy. And I trust that report more than I do the US jobs report or the non-farm payrolls report, the one that everybody takes a look at. According to that, which came out on Friday, we created 353,000 jobs. Although if you look in the report, again, full-time jobs are being destroyed, part-time jobs are being created. And every single time the BLS releases a number, they're doing two things. One, they downwardly revise the previous results. So the numbers in the past weren't really as good as they were announced at the time because they're going back and making adjustments. And two, they've been fiddling with the overall count of jobs holistically across the report, and they've moved it up, they moved it down. And it seems like they're trying to find the just right porridge or the just right bed, according to the Goldilocks story. But the problem is that they're manipulating the numbers all the way through. And so that number, the jobs number, becomes less and less believable to the point where I quote it, I don't believe it. And especially when you look in their own data and you show that the good jobs are being destroyed and bad jobs or lower paying jobs or temporary part-time jobs, not bad jobs, but less fruitful jobs are the ones that people end up taking. Productivity in the US is down a lot. It crashed down to 3.3%. Last month, it was up 4.9%. So yes, it is gaining a little bit in terms of productivity, but not nearly as much, which is a sign of a slowing economy. Manufacturing Purchasing Managers Index, an indication of where we are in terms of manufacturing growth, is at 50.7. It's slightly above 50, which means it's slightly into the positive territory. However, that's not very strong, and it basically indicates stagnating manufacturing. Looking at the manufacturing prints the last few months across the regional Fed surveys, and we come to see that manufacturing is actually cratering in the United States and is not expected to do better. ISM manufacturing, another measure of manufacturing in the US, we have lots of these different manufacturing surveys, is actually down to 49.1, which is below 50, which indicates a contraction. So for the most part, I think manufacturing construction spending is in contraction. Unemployment rate was quoted at 3.7%. I ignore it. Hourly wages are up 0.6%. That's not keeping up with inflation. So workers are going to have a harder time coping with what's going on in the economy. As we look forward to credit card delinquencies, it says here credit card delinquencies surged more than 50% in 2023 as total consumer debt swelled to $17.5 trillion, the New York Fed reported Tuesday. Total debt rose by $212 billion in the quarter, a 1.2% increase quarterly and about 3.6% from a year ago. And remember our reporting the last few weeks in which the amount of revolving credit debt used was almost $20 billion, which was the second highest in history. The only time it's ever been higher is when they actually shut the economies down during the health crisis in 2020. You read it right. The second largest use of credit in a fully functioning economy that the economists are saying is great, and the politicos and the news programs are saying is great, but yet consumers use the second amount of highest credit card usage. I believe that was last month. And this month, the delinquencies are up, indicating a lot of stress in the system. The quote from the article from CNBC, Debt that has transitioned to serious delinquency or 90 days or more past due increased across multiple categories during the year, but none more so than credit cards. With a total of 1.13 trillion in debt, credit card debt that moved into serious delinquency amounted to 6.4% in the fourth quarter, a 59% jump from just over 4% at the end of 2022, the New York Fed reported. The quarterly increase at an annualized pace was around 8.5%, the New York Fed researchers said. In addition, in this report, delinquencies also rose in mortgages, auto loans, and the other category, which is other types of debt. Student loan delinquencies moved lower, as did home equity lines of credit. Overall, 1.42% of debt was 90 days or more past due, up from just over 1% at the end of 2022. A quote from the study: "Credit card and auto loan transitions into delinquency are still rising above pre-pandemic levels," said Wilbert Vander Klauw, economic research advisor at the New York Fed. This signals increased financial stress, especially among younger and lower income households. So yes, the economy's not great. Those part-time jobs are not making up for the full-time jobs, and wages are not growing as fast as inflation. And we have crashing sectors in the economy, leading to people using credit cards and getting into some serious trouble. That's a big story of the week. Moving back to the economy, Treasury rates are spiking, and so are mortgage rates. I reported this on Twitter last week and over the weekend. The U.S. 2-year spiked up to 4.395. Now it is down 0.077 on the day, but it's been up the last 4 to 5 days. The 10-year is at 4.092. You'll notice that we're still in yield curve inversion, which means that the 2-year rate is priced higher than the 10-year rate, which means that investors are expecting more return for the shorter term issuances than the longer ones because they see more risk ahead, and that is a sign of a coming recession. We'll continue to watch that. Overall, the cryptocurrency complex is in the green today. Bitcoin is up $808.37 at time of reporting to 43,196. And the cryptos seem to be doing pretty well in light of the economic turmoil that we have. Big story of the week: the banking system is coming back. Remember last year when we had those big bank failures in the US, and we also had Credit Suisse run into some financial stress? Well, UBS took over Credit Suisse, and now their shares are sliding as earning miss darkens the outlook. According to the headline, CEO warns 2024 will be pivotal. This is as from Zero Hedge. Quote, UBS shares in Zurich fell nearly 3% after the Swiss lender's fourth quarter earnings fell short of Wall Street's expectations, even as plans to increase its dividend per share and reinstate share buybacks this year. The Zurich-based bank reported a net loss of $279 million for the fourth quarter, its second straight quarterly loss since its emergency acquisition of rival Credit Suisse. However, analysts surveyed by LSEG were expected a wider net loss of $372 million. So I guess it came in a bit better than expected, but it's still not good. Recall last March, the article says, quote, during the regional bank meltdown in the U.S., across the Atlantic, Swiss authorities orchestrated UBS to take over Credit Suisse for $3 billion to avert a much larger global banking crisis. This is at the height of which the U.S. banks were in crisis. Also, the European banks are starting to go in crisis. It says, quote, the deal was the largest of its kind, turning UBS into a 1.7 trillion giant overnight, except for the fact it had to take on Credit Suisse and its screwed up portfolio of non-performing assets. Last quote from the article, UBS said Tuesday that its forecast deeper cost cutting by the end of 2026 to the tune of $13 billion, $3 billion more than it stated 6 months ago. Since the takeover, UBS CEO 𝘎𝙬𝙬 declared the first phase of the integration between the two banks complete. He said progress over the next 3 years will not be measured in a straight line. As we move to the next phase of the journey, 𝘎𝙬𝙬 said, we will focus on restructuring and optimizing the combined business. While our progress over the next 3 years will not be measured in a straight line, our strategy is clear. But overall, the bank is not doing well. And again, the banking system is not in good shape. On to China. We have some issues with China, and I'll show you a chart here in a moment, but I want to talk about an IMF quote on China. A quote from the article at voanews.com. IMF predicts China economy slowing over the next 4 years. Quote, the International Monetary Fund says China's economic decline is likely to continue over the next 4 years as the world's second largest economy deals with a range of challenges from a rapidly aging population, higher unemployment, and a property crisis. In a report released on Friday, the global financial policy body, also known as the IMF, projected China's economic growth would drop to 4.6 this year, down from its 5.2% growth in 2023, and fall further to 3.4% by 2028. The property market, which has historically represented about a quarter of China's GDP, has been a particular area of trouble for the Chinese economy lately, with a Hong Kong court on Monday ordering Chinese property giant China Evergrande mired in more than $300 billion of debt to liquidate. An IMF analysis released Friday predicted real estate investment is likely to fall 30 to 60% in the next 10 years relative to 2022 levels. Last quote from the article: absent a comprehensive restructuring policy package for the troubled property sector, real estate investment could drop more than expected and for longer, with negative implications for domestic growth and trading partners, the report read. Another story, a big story of the week: U.S. strikes more than 85 targets in Iraq and Syria in initial barrage of retaliatory attacks. Quote from the article from NBC News: the United States launched attacks Friday against 85 sites in Iraq and Syria used by Iranian forces and Iran-backed militants. Its first retaliatory strikes for the killing of 3 American soldiers in Jordan last weekend, U.S. officials said. U.S. military forces struck targets at 7 facilities tied to attacks on U.S. personnel in the region, National Security Council spokesman John Kirby told reporters. U.S. Central Command said the facilities included command and control operations, intelligence centers, rockets and missiles, and drone storage sites. Our response began today. It will continue at times and places of our choosing, President Joe Biden said in a statement. The United States does not seek conflict in the Middle East or anywhere else in the world, but let all those who might seek to do us harm know this: if you harm an American, we will respond. But I'm curious for President Biden, which Americans were harmed in the Gaza Strip other than the ones that we sent there after Israel invaded? I do know that there was retaliation for us supplying them arms by supposed Houthi rebels from Yemen and in the Red Sea. However, I would point out that the U.S. got involved in this war before they did. So ultimately, you have to look at who started the firing. Last quote from the article: the military action is a significant escalation of Washington's bid to deter the growing threat from Iran-backed groups across the Middle East, a step fraught with risk abroad and at home as Biden seeks to prevent the Israel-Hamas war from spiraling into a wider conflict while working to secure his reelection. That's what the article says. I think he's actually amplifying what's going on in the region by getting involved in the first place, which I've never been an advocate for at all. I don't buy the excuses the government's using. We're over there supplying military aid. It just came out in Ukraine. $1 billion of U.S. military equipment is unaccounted for and can't be found. $1 billion of arms and military equipment is running around somewhere. Either the Ukrainians have it, or the rebel, or the other side has it, or somebody has it, or went in the hands of the citizens, maybe the Russian. No one knows who has it. It's not there. And so that is an issue. Definitely mismanagement of assets out there. And of course, we're doing this again in the Middle East. And I did point out a couple of months ago that I thought that this could lead to a broader war. We're in the broader war now. We brought Iraq into it. We brought Syria into it. There's talks about bombing Iran as well. And so you could have the entire Middle East go up in a giant flame and a giant war action here pretty soon if we're not careful. So constantly have to check and see what's going on there, because that will change things economically quite a bit as we get closer to that situation. So back to China for a moment, because there is an issue with the Chinese stock markets now. It's not just the property markets. And I wanted to show this chart. Here is where China government said that they may start intervening in markets to stop the slide of the economy due to Evergrande and the brewing real estate situation that they had in the last 1.5 to 2 years. And ever since they've gotten involved, China has crashed, losing about 7 trillion in stock market value, overall 7 trillion yuan, and stock market value, which has been an absolute huge crash in their markets. It doesn't look particularly good for China. China looks like it's melting down a bit. And I think that that's going to continue to exacerbate geopolitical tensions as well as economic tensions with the United States. The United States has its own problems, so does Europe. So it looks like the world is heading toward a deflationary collapse, in my opinion. Although it does seem like it's going to take a little while to get there. It means we have a little bit more time to prepare if you're on that end of it. With that, we're going to move over to the gold and silver report. Here are the gold markets according to the CME. And as you can see here, overall, not too bad. The big month right now is solidly April for the gold derivative markets. The reason I always point these charts out is, one, to show you how it actually works. If you want to know where spot price comes from, it's not your local coin dealer. It's not the wholesaler. It's not the miners. It's not anything other than a paper traded market in the Northeast, in the United States, in the UK, in London, and other places like China. Very small aggregation points at which prices differ across all of them, by the way. There's not a market agreement on price. and it's done using paper trading. It's not done using physical. So this is the CME Group's website, which runs the American markets. I'm going to point out that they're trading April. Why are they trading April when we're in February? Because it's a futures market. And what they're doing is they're betting on the price of gold up or down in April. And they're not counting long-term effects of the economy and all that other stuff. It may be in the back of their head, but they're looking at where's it going to be in the next couple of months. Well, with no crash happening right now, gold price is not going to rise a whole lot. They're betting on pennies on the trades, essentially. It's not until we get into some sort of crisis that you're going to see gold and silver rise, as it did last spring when we had the bank failures. So if you're worried about that, don't worry about that too much. The derivative markets will reflect reality when reality hits. But right now, they're not pricing in future risk from a geopolitical or economic standpoint. They're pricing in future risk of where the price changes may be, and they're all guessing as to what they may be. That's how that works. That's why they're trading April. Now, deliveries have to come on the current month. So we did have 216 deliveries. Now, February did have quite a few deliveries in it. I'll show you those deliveries here in a moment. But overall, the trade looks pretty range bound. There are a lot of EFPs, and that's movement to get exposure to the physical gold market over in the UK, taking a futures contract in April and going to the UK and saying, can we get exposure to the real physical market? That tells me people in the US are hunting for physical and that the prices are too cheap here. That's why they're moving a contract from here to there. That's what they're doing. EFPs have stayed elevated. That was Monday's data. If we look at Fridays, there's 37.91. So you see that number right there. If we look at Thursday, in fact, we can just do it on the top line, 28.42. So you see right here, 28.42 EFP. And then we move to Wednesday, we had 9,237. And on Tuesday, 3,376. The EFPs are extremely elevated to what the par has been for the last 5 years. I've been following this market in detail every single day. And I've never seen EFPs this strong for this length of time, which means one, gold is priced too cheap in America. And two, there's not enough physical demand in the current month because there's not a lot of contract trade going on right now. It's all in a futures month and you can't take delivery until you're in the current futures trading month. So you can't take delivery for April gold until April, but you can take delivery of February gold. There's not a lot of February contracts going on, only 15,980. And so they took what they could get in February. There's a lot of metal that came off, but they're having to move it over to the UK market to try to get it now. Looking at the settlement data, this is where the price action is. I do this so that you know how spot is determined in the US. It's not your local coin dealer. It's not your wholesaler. It's not the manufacturer. It's not the miner. It has bupkis, zero, nothing, nada, zippo, zilch to do with the physical market. And I explain this every time on the week. And I explain it to people who come into the store who don't believe me. They're like, oh, the dealers use spot. Yeah, we use spot price as a reference point for setting prices. But this is all based on paper trading, not physical. And that's the way the US market works. It's a fugazi. We all know it's a fugazi. It's the way it is. There's nothing that can be done about it right now until that market breaks. But as of right now, this is the way that it works. So again, April contract is where you're seeing a lot of open interest. Today, there's been some open interest as of about 12:30 Central Time, 113,000 contracts. Yesterday, it was 343,462. The prices are trading up about $8.50 on the day. If we go to Monday's data, they traded down $11. Again, all paper trading, no physical crossing hands here. Down 1740 on Friday, the big slam, the straight line down we saw in the morning, and then it started to recover a little bit during the day. That's what happened there. We go back to last Thursday, it was up 370. Well, why is it up and down? Well, we're going to go over the COT report in a minute and show you, but I want to go over silver first. Looking at silver, some elevated trading here. It's going to be mostly short action. When you see these bars get taller, it's usually more shorts coming in, almost always, not always, but almost always until we have a market event. And then when these get big, it'll be going long. And that's generally the way that that trade works, especially with silver. Silver is very range bound between, say, 20 and 25 bucks until something big happens, and then it tends to go pop. Okay, it takes something big happening to move silver. Gold usually moves first, and silver, sort of a little brother method, will move after. But until then, a lot of shorting going on. We'll show you that in the data here in a moment. The big contract right now is March, but we see some of it rolling over to May, as there are 30,000 contracts trading in May against 98,000 for silver in March. Only 13 deliveries in yesterday's trading data. Overall, not too many deliveries in silver. We had 70. On Wednesday, the 31st, we had none. And on Tuesday, deliveries only 93. So not a lot of deliveries going on in the silver market physically, but there are some EFPs, like as you can see right here in this column, EFP right here. And those are movement over to the UK market to try to get silver again, because silver is mispriced here and they want access to the physical over there. That's why EFPs exist. Overall, healthy amount of trade in the March contract. Let's look at price settlements. If we look at data as of today, about 12/31, this partials days data, we're up about 5.4 cents. Nice to see silver up. On Monday, it was down 37 cents, however, and I'll show you why in a moment. On Friday, down 43 cents. So big slam in silver the last few days, up 6 cents last Thursday and went down 6 cents. So overall, it's not been too great for silver the last few days. That has to do with positioning of traders. Now, this is older data, January 30th. It's about 6 days old. It usually gets about 8 to 10 days old before they release the new one at the end of the week. They're always behind, but looking at what's going on in silver, more shorts added by the bullion banks, the swap dealers right here. They're the ones that have the biggest positions. Why do I pay attention to the swap dealers? Okay, let's look at the silver chart. This is silver. These are other metals. You got platinum, palladium, gold. I'm highlighting the silver part of the chart here so you guys look at it. And the reason I do this chart is because it's on the government's website. I want you to see it live. This is the way they do it. I'm not going to put it in Excel and make it pretty for you. I want you to be able to see it here. So you see it live, so you know I'm quoting what the latest numbers are according to how they report them. I'm not making this up. Why do we pay attention to the swap dealers? Because according to a combining data from the CME group on the market and the OCC, Office of the Comptroller of the Currency, we know that 4 traders hold 32% of all shorts, almost a third. 4 traders, 4, and they're banks. And top 8 traders, which include banks and investment houses and those types, hold 48% of the shorts. Now, there are some minors in here as well, but for the most part, the big guys are banks and they're financial houses, and they hold all the shorts in silver, and they have for as long as I've been covering this for about the last 10 to 12 years. And I'm sure they probably did before then as well. When I look at old data, that's what I see. They increased their shorts 1,378. Why is silver price falling 44 cents? Because they increased their shorts 1,378. You see how that works? They increase their shorts, and the following week, what happens to silver? It falls, cause and effect. It's a paper market. Notice there's no physical anywhere in this equation, period, end of story, zippo, zilcho, none. Okay? So the physical market doesn't determine pricing, which means when there's a shortage, things tend to get very exciting very fast, but up until then, they can be a bit boring. But the banks basically control that market. The managed money took the other side of that and went long to the tune of 3,406 contracts, and they absorbed that from the banks, as they always do, and the banks will make money up and down because they just play around with the price. Now, moving on to gold. Gold did pretty well. And why did gold do pretty well in the last week? Because they dropped, the bullion banks dropped 17,638 shorts. And they dropped some longs, but net, they're still down about 17,000 contracts. That's a lot for a week to drop shorts. When you drop a short, you're dropping short selling pressure, which allows the price to slowly rise. That's what happens. When you drop that many, it allows it to rise quite a bit. So gold's done pretty well the last week. Again, top 4 traders, same banks, 32.8%. 8 traders, same banks and financial institutions, 51.1%. These are the guys that push the price around. It's right there in the report. It's basically irrefutable. Now let's look at deliveries. Let's look at my NYMEX metal. Metal deliveries. There we go, right there. We're going to hit Google. And I want to show you what the deliveries have looked like so far this month. So let's blow this up just a bit bigger. And as we go down to the COMEX 100 gold futures, the first 2 days, which you could take gold off the markets in January, a lot got taken off. 11,000 contracts on January 31st and 3,700 contracts on the 30th. Now, this is for the February contract because the COMEX gives 2 days ahead of the first of the month, 2 business days ahead of the first trading day of the month, to announce that you're going to stand for delivery. It gives people a couple of days time to prepare to actually deliver physical metals. So you'll see the first 2 days before the month begins, last 2 trading days before the month begins, you'll start seeing delivery notices. So we saw 3783 on the first day on the 30th, and on the 31st, 11659. We're up to 16,151 gold deliveries for the month. That's a lot to begin the year. People want physical. Now, if this were determining the actual price, you would see much higher gold prices because look at all the deliveries. This is of 100-ounce gold futures. How much gold is that? It's, 1.6 million ounces of gold requested through these contracts, 1.6 million ounces. You move the decimal over 2 spots for 100 gold futures, 1 decimal, 2 decimals. Move that over 2 spots, 1.6 million gold ounces. in the span of about 5 days for delivery. And remember last week when I said there was almost 1 million ounces moved off in a day, I think it was 877,000 in one day. Well, in 3 or 4 days, you're another 1.6 million. People want gold and they're taking it. Now, if this determined prices would be much higher, but it's not. It's all this paper garbage on the market that determines prices. It's right here on the chart. And so that's where you don't get rising prices, even though physical demand is strong. Well, what about silver? How's silver doing? Here's the 5,000 silver futures, 547 deliveries of 5,000 ounce silver, more ounces in a contract. You add an extra zero, so that's still quite a bit of silver movement on that market. And we're going to get close to ending up this broadcast with my thoughts for the week. So my thoughts overall on the market as we get through the news, the stories, and the metals are that there is a very healthy appetite for metals, especially gold, in this environment at the industrial and the big player level, the heavy commercial level. The derivative prices are not reflecting that. That is no surprise whatsoever. For those that may be frustrated on the retail level, don't worry too much about that. That gives you cover to buy metals at cheaper prices right now, if that's what you decide that you want to do. Make your own decisions, consult your own investment advisors, do your own research there. But I think it's a wonderful opportunity to get into metals if you want to. Prices are low. And the way that this market works is a derivative market doesn't price in risk until it's right in front of its face. And when it's right in front of its face, it's going to price it in and prices will go up. Until then, it's going to range trade and they're going to play games, with the prices. Overall, looking at the situation with the economy, not great. It looks like manufacturing is basically cratered. Property market has gotten too expensive. Prices continue to rise. Interest rates are going up. Bond rates are going up. Mortgage rates are going up. At the same time, prices are going up. It's just going to price homes out of more people's budgets and out of their hands to where they can't get to it. And eventually, it's going to lead to a collapse of the real estate bubble. These bubbles can go on for quite a while before they finally do collapse. But when they collapse, it's a waterfall straight down, usually down to whatever level they're going to go. And they'll pass through what is a reasonable point below that and offer bargains for people. That probably won't happen for another couple of years, but the crash is going to start probably, I would imagine, within a year to 18 months. I'd be shocked if it doesn't. Of course, that has a lot to do with the economy. As we look at the economy, consumers are tapped out. They're using more revolving credit than they ever have before. And now delinquencies have started to bust on all markets. Credit delinquencies on credit cards, student loans, the auto market, and the real estate market, as the New York Fed reported, and we've been reporting for several months. They finally came out and said it all in one report. We've been saying it the last few months, so it's nice to get confirmation from the Fed there on what's going on. Overall, just not a good setup. It's not just stagflation. We're heading towards a crash, and not really a good setup for the consumer unless you're protecting yourself in alternative assets, which I will recommend. Again, do your own research there. And overall, I think the metals market's going to do very well going forward. I think a lot of people agree with that. I think there's some other alternative classes you can get into, but I think the metals it's where it's primarily going to be at in the next several years as we progress through this deflationary crash. And again, it's not just in the US. We saw it in China. China is basically imploding right now in the real estate market, which is leading to other issues with their stock market. Eventually will lead to the banks and will lead to the solvency of their system. And on top of all that, we've got more geopolitical tensions. Now, if you look at the history of geopolitics, when you have economic issues, it leads to geopolitical issues and war. That's been the playbook, or what has resulted on the timeline many, many times in the past. So I expect to see more warmongering, more fighting, more shouts for independence. But we also, beyond those types of wars, we also see civil unrest within Europe and the United States, more riots, more protests, and things like that are coming as well, as the citizenry of the Western world tends to get frustrated with the economic issues and with their politicians who are making all these choices that don't seem to edify what the citizens actually want. There's a little bit of cognitive dissonance going on, but then that leads to a rise in anger, and it leads to additional civil action there as well, which is why the protests are up all over France and Italy and Belgium, and also in the US as well. With the trucker convoy, for example, leading from Florida to California as an example. And then we had one like that in Canada as well last year. So you're starting to see that all over the Western world. So that's the prognosis and the outlook for this week. We, of course, will be back next week to do this all over again. We do it every week to fill you in on what you need to know. We sort through the data, we sort through the stories, and we sort through the gold and silver markets and present this to you in bite-sized form. And we're going to do it in just under 30 minutes today. Remember what I have on sale: silver revolvers, $400. $50 off. We have silver die, $6 off at 70 each die. And we also have silver maple leafs on sale for $27 each. You can get those by going to www.goldsilverpros.com, clicking on the discount link and filling out the form. And I will call or email you back and get an invoice sent out. You cannot get those by going to the regular online store. Thank you so much for tuning in. This has been Rob Kientz with Gold Silver Pros at www.goldsilverpros.com.